Feds cut the rates, but the mortgage rates are higher. Let's dive deep into what's going on in the market. So, the Feds cut the rates, but the interest rates started going up. The fundamental reason? The interest rates are not guided by the Fed policy. The interest rates are guided by the 10-year Treasury yields, and the yields in fact went up. Contradiction number one. You might think that the Feds dropped the rate, so interest rates will go down. But no, what actually happened is the market is currently in a sticky situation. The Feds cut the rate because the job market has tightened. There's a lot of job losses. And so the interest rates have been reduced by the Feds to accelerate the job market. But on the flip side, the inflation is still not under control. So that's on sticky ground. And so the yields actually work in tandem with inflation. And so that's the reason why the mortgage rates in fact went up. Contradiction number two. You might think that the Feds dropping the rate is going to affect borrowing costs. In fact, the borrowing costs are not in control. In fact, we are going to see the rates not go below the 5% kind of a number. If you are expecting the rates to go down below 5 or 3% like what they did during COVID, it was during COVID. It was once in a lifetime event for most of us. And so that is when we saw the rates drop to that completely catastrophic low. That is not where we are going to see the rates at all. So we are going to have to contend with the rates being in the fives or around the fives, and at the same time plan our lives based on these rates. If you don't do that, you are going to miss the boat. So, news does not translate to actionable items or action. Take the news, analyze it well, reach out if you have questions, and happy to discuss how this works. Thanks for watching. See you on the next one. Bye.